ready to kick this off, before I give it away to Don and Yoni to talk about deal by deal versus fund, how all that works, the intricacies and everything around that, I just want to share a little bit about myself and about where I work and why I'm here. So my name is Asaf. I'm the VP Marketing at Agora. We're the sponsors of this webinar. We're a real estate investment management platform helping GPs and LPs build better relationships and become more efficient in their operations. And instead of pitching the company, I'll just talk about my relationship with Don, because I think that's the most significant piece here. As I grew into the real estate space and learning more and more about it, I happened to stumble upon the largest commercial real estate account on social media, which is the StripMallGuy, which all of you know and are aware of. And as part of that, I said, I really need to meet this person. I really want to talk to him. And fast forward, it's been 2 years that we've been having a lot of conversations and building a very strong, close friendship. Don is my one of my go-to people when it comes to real estate. He's the person that I look up to when it comes to real estate, and I'm just really happy about this connection and the relationship that we have. And as part of that relationship, I've built a relationship with Yoni as well. And I'm just excited to let you guys do your thing, talk about the real estate, bring people the information that they're looking for when it comes to fund versus deal by deal models and how all of that works. I think it's going to be extremely excited and beneficial for this audience. And without further ado, Don, Yoni, I'm going to let you take it away.
Thank you for that. Thank you everyone for joining us. Kind of blown away. I think there's 1,000 people. We hit our limit on number of folks joining today. So a lot of interest on deal by deal versus fund. Want to intro Yoni Tepman really quick at DLA. If you want to give a quick intro for yourself, what you're up to, and then we'll kind of get going.
Yeah, thank you, Don. Thank you, Agora. You and I met Don like 3 or 4 years ago, was it?
Yeah.
We worked together. I think we met in Midtown Manhattan. Was it Bryant Park? That was the beginning of a great relationship. I myself live here in LA. I have 6 kids. My oldest graduated high school last year. My youngest is in pre-first. I say that because it's important as a lawyer. Why? Because 2 reasons. Number one, I have a lot of mouths to feed, so I'm very eager to work hard. And the second thing is I have a lot of reason to escape the house and go to the office. So that's me. I form funds of all types. Real estate funds are bread and butter. And I'm excited to talk, Don, about the process and your story.
Great. Thank you for that. And thanks again to Agora, obviously. And so I'll jump right in. So I was buying real estate deal by deal, like most people, how they start, in 2007. And what that means is, of course, you're out there looking for deals. When you come across one, you're scrambling to get the deal and get under contract, make an offer, do some diligence. But as far as the actual capital goes, you're also very much scrambling to call folks in your network and say, hey, I'm doing this deal I want to do, will you put in capital? Now, after a while, very commonly, a lot of those folks will invest with you time after time. And so it isn't a huge stretch, but, you are spending time pitching people on a deal, right? And so they're going to have questions, they're going to have calls, they're going to push back. Maybe they're going to sit out a deal that you thought that they would do. And also, even if you have investors that, are not going to push back and they're going to be with you, that $1 million that they said that they had for you today may easily not be around anymore in a week or a month or 2 months or 6 months. People's lives just changed. Some new unbelievable deal just came up. Money that they thought they were going to get didn't come in, and also your main investor might be in Vietnam this month. It could be middle of the summer and he or she, they're on vacation, and that $3 million that you could count on, now good luck getting that person to kind of stop their African safari or whatever it is and take time. So the challenge with deal by deal is the effort that it takes you to actually, fundraise every single time, which is a challenge. Now, with a fund structure, right, you don't have that process, right? Folks are investing in you, right? You're not pitching a deal, you're pitching yourself. And the only way that someone who's sophisticated is going to invest with you in a fund is if you have a track record, right? Because what you're saying to them is, I think I'm an expert. Don't worry about what I'm buying. Here's my thesis. I'm not going to, run these deals by you because you have hired me because you think that this is what I'm an expert at, right? And so you're committing to an amount up front, right, based on track record. So, number one thing, don't even think about a fund structure, of course, if you don't have a bunch of deals under your belt. Someone would have to be crazy to invest blindly with you if you've done 0, 1, 2, 3, 4 deals. It's just not enough. It's just not going to work, right? And so, a lot of folks are, oh, I'm going to start a fund right away. Like, no one's going to give you money who knows what they're doing. And so for me, the main thing about a fund, as I transitioned over and thought about it only 4 years ago now, I guess, is number one, I did not want my business to change, right? So I've got my core thesis, I buy these kind of deals, things are going well. I don't want the fund overhead, whatever that entails, to disrupt any of that. That's number one. Number two, look, I was intimidated by real estate fund. What does that mean? That's intimidating. Legally, what do I do? There's, SEC stuff, 506C. That's going to be really expensive. And so I went online, Googled, whatever. There really is not a lot out there that's really great. And then, I got on a call with someone introduced me to Yoni, who is one of the best, fund formation attorneys in America, securities lawyer. And yeah, that call went from me being like, what is this all about? And, kind of nervous to, Yoni's attitude of like, we got this, right? Which is his style of like, don't worry about it. We got it was a big difference maker for me. So Yoni, why don't you take us back? So when folks like me who've been doing it a while, deal by deal, want to transition into a fund, what kind of things do you go over with them on those initial calls?
Great. Yeah, thank you. First of all, I got to say you hit it on the head. I'm going to answer your question, but I want to just underscore something you said in terms of when you're raising money, syndicating deal by deal, folks are investing in the deals. When you're raising a fund, they're investing in you. I say that all the time, and I think that was like spot on. Let's go back to our first call, right? I'll have a call with a new client and they'll say, look, Yoni, I've done 10 deals. I've done 20 deals. I have my team. But they say like you, Don, I'm always going back to the well. And then they also say, I'm not able to really build a team and scale because I don't have like a set stream of basic management fees that help a firm hire the appropriate people and grow the way it makes sense, right? But then they're always struck with trepidation, as you were, and you were not alone. This is you'd be crazy not to, because you're stepping into something that's so unknown. And so I tell people all the time, I'm a lawyer. Maybe 6% of my day is spent practicing law. 94% of my day is spent just relaxing, coaching, teaching folks who are emerging managers. Look, you've done SPVs, you've done syndications. You've already done 90% of what you're setting out to do now. The laws don't change. If you've raised money through private placement of securities in an LLC to buy a property, or you've done that multiple times, then you've already done what you're about to do through a fund. So let's think about it. Let's break it down. The structures don't really change. You're forming a vehicle to take investor money. The vehicle you will manage. You will share the profits. That's essentially the structure. Maybe there's another entity or two on top in a fund that you may not have, or you may have in a syndication model, but essentially the structure is not changing. The laws and regulations are not changing. You're raising money from investors in either case, right? The structures, the laws, the regulations, the documentation, right? The types of documents. You have a governing agreement for your entity. You have a subscription document of some sort. You have disclosure document of some sort so investors know what they're buying into and what can go wrong. That is true in both sides of this equation, syndications and funds. So what's the difference between the two? The terms. The terms of a fund agreement are somewhat different, a lot different, than the terms of an LLC that's buying one property. But if you can take a step back and internalize that 90% of what you're going to do, you've already done, then you can start to relax. Okay, who can help me understand the 10% that's new here? Who can guide me what type of terms are appropriate for my fund and my firm? And we're off to the races. So that's a lot of the first conversation is, don't worry, you've already done a lot of this. There's some of it you haven't done. Let's coach you how that last 10% works. And maybe it's not 10%, maybe it's 20%, but it's less than half, right? Most of it you've done already. And we can get into details about how that works, but.
Sure. It's funny because last week, like when we had our kind of prep call, like you talked about how when folks approach you, you're like, listen, before you go spend money on me and on doing things, why don't you have a teaser that you put out there and see if you could raise the money. So take me through quickly, if someone has a teaser, what does that look like? And what are the legal ramifications there as far as, when they're sending out track record, is there going to be fine print there? Like what obviously there's like a disclosure aspect or legal aspect there as well, right?
Yeah. Let's answer that. I want to explain the process. I think if you think of it in this way, I'm a big believer in this process. There's 3 phases to this. Okay. You're a real estate syndicator. You're thinking about a fund. Think of it in the following paradigm, 3 steps. Step 1, design the thing you're looking to potentially build.
Yeah.
What does that mean? Sorry, let me go through all 3 steps, then we'll go back. Step 1, design it. So you know what it looks like, which we'll double click on in a sec. Step 2, build what you've already designed. Okay. Step 3, now close the fund. Let's talk about those 3 things. You're designing something. This gets to what you asked, Don. When you're designing a fund, you have to know what the structure is going to look like. What entities are you forming? Where are you forming them? What type of entities are they? LLCs, partnerships, something else? Are you going to have US entity, offshore entity? We can talk about that later too. What's the structure chart look like? That's the first part of the first step. There's 3 parts of the first step. That's 1. The second is a summary of terms for your fund. Here's where your fund really differs from your syndicated LLCs. It's the terms, and this is going to be where things are new to you.
Yeah.
Get on the phone and talk through. You need a guide. You need a Sherpa. You don't know what the terms ought to be. You don't know what the options are. Let's talk through common terms. I say everything I want a real estate fund manager to think about, we'll raise with you. Don't worry. We're going to raise the questions with you, and then we'll guide you through the various options, how to design the fund. That's the second really important part of phase 1, right? Structure chart, summary of terms for your fund. What do the economics look like? All the other terms of the fund. And step 3 of phase 1, Don, is what you mentioned. Your teaser, your marketing deck, PowerPoint. Could be a page, could be 20 pages. Yes, there will be fine print on that. Anything that you're using to potentially sell securities, that's what you guys are doing, right? Whether in an SPV, a syndicated LLC, or a fund, you're selling securities. You don't think of it that way, but that's what you're doing. So yeah, you always want to be careful when you're selling securities or potentially selling securities, what you say and how you say it. So that's the easy part for the lawyer, right? Because you'll write your deck, you have the idea, you put your slides together. We will review it to make sure you don't get into trouble. But that's phase 1.
Yeah, it's funny because, on that deck, I'd never put our story into writing like that before, right? So in all of our deals, we had, 29 exits in a row that were successful, knock on wood, right? But like, my thesis, how we do it, was not something I ever stopped and put on paper in a deck. And when I started fundraising, I was like, well, no big deal. I'll just do, I'll just put it together. No big, I know what I'm doing. And I think I underestimate how difficult it is to take this whole, all these years of deals and say, okay, like, how do I summarize it? It took me probably 6 months of like, 40-hour weeks just on that because, I know that a lot of LPs might not get through the third or fourth pages of a deck. It's just attention spans. It is what it is. And I knew, I really had to capture their attention with, what's the most important thing, in the first, second, third slide, right? And so just figuring out like every word of that slide, I analyzed, how does this come across? Is this really the best use of the real estate, on the slide? And so that was number one for me, and putting that pitch deck together. And there's no like, I mean, there is, but there isn't a company that will just like do that for you, right? And it's like, I speak that to other GPs, and it's like, you can't really outsource that. You outsource the graphics. I tried, I was like, oh, everyone must just have a third party do it. And originally I had someone work with me and I was like, this is absolutely terrible. I have to do this myself. And so I worked with a designer and, I was doing all the data research and everything like that. So it's like, don't underestimate how much time and effort it is to tell your story. Right. And then there's the PPM, of course. I'd never heard of a PPM. So that Yoni, will you really quickly tell everyone, along with your deck, there's something else which is a little bit longer, PPM. What is that?
May or may not be a PPM. So in phase one, you have a structure chart, you have a
Yeah.
summary of terms, you have your marketing doc or deck. It's as short as long. I think they quoted the name of George Bernard Shaw. I think I may be wrong. I think that's what they quoted his name. That he was writing a letter, and then he said at the end of the letter, "I'm sorry, my letter is so long. I didn't have time to be brief." And that's what you were saying, Don. And I think it's such a vital exercise to really take the time. It takes time. It takes time to be brief. Let's condense. Let's consolidate so we get the core of what we are and what we're doing. Put that on the slide. So I echo I need that sentiment. I think that's the most important part of the process. That phase one, that design. Have you ever built a house? If you've built a house, or everyone here does real estate investing, any building that you build, try to build a building with a badly designed set of plans. An architect that you skimped on and things don't match up, and now you have the construction going and you're looking back at the plans, it is a disaster. This is the analogy for raising a fund. It all gets back to the plans. Build the plans, the specs perfectly. As perfect as possible, right? Nothing's perfect, as perfect as possible. And then when you're on site building your fund, it's going to be so much easier and cheaper, right? It's just going to be amazing. So let's talk about a PPM. We've done phase one. We designed everything. We haven't spent time or money building anything yet, but we have our design. It takes a week, not a big investment. You have your design. Now you go out to the world of your investors. You knock on the doors of all your investors who've invested with you on a deal-by-deal basis. You pound the pavement with others, and you share those design docs with them. When they say, "Don, I like this. I like the vision. I'm ready to look at like what can I touch? I want to see the legal docs." Then you move to phase two. Okay? Phase two is the build phase. We design, now we build. What are we building? We're forming entities. We're forming the fund. We're forming the GP. Maybe there's something else we're forming. Okay? And we're putting together the investor-facing documents. So you can open up your data room to your investors, or you can email your documents out, right? What does that consist of? A partnership agreement, 9 times out of 10, your fund is going to be a partnership, not an LLC. We can talk about why or why not. It's not a big difference, but most funds are partnerships. You form your governing agreement, your partnership agreement. You form your subscription booklet that the investors have to like read and sign and check different boxes in order to get into the fund, right? That they're sophisticated and know what they're doing. And you probably also have a PPM. Now, PPM is like an expanded version of your marketing deck. It's a joint venture between a law firm and their client. And you remember this well. I can see from the smile. Maybe you tried to put it out of your mind.
We wrestle on that a little bit because, right, like that has every possible risk that an investor could take on, and you guys lawyers like to go a little bit far. Where I'm like, okay, you guys, that is. If I was reading that, it'd be a little bit spooked. Can we just lighten that up a little bit? And so we definitely have a back and forth on that.
Yeah, half of the PPM, or I would say, depending on the PPM, 80% of the PPM we do. It's risk factors and conflicts of interest and securities law and the tax disclosure and country legends if you're raising money in wherever, right? And there's a summary of terms of the fund. So the actual design docs we put into the larger marketing document called the PPM, the private placement. Great comment. I was just about to say private placement memorandum, PPM, or it could be called an OM, an offering memorandum, but it's the document that is not legally required. It's a marketing document, okay? It serves two purposes. It's a marketing document that also protects the GP by warning the investors of what can go wrong. So God forbid something goes wrong, the investor doesn't say, hey, Don, you promised me the world. You didn't tell me that an earthquake can come and swallow up the building and that the tenants are going to default. And so, no, I told you everything can go wrong. And plus, so the PPM serves those two purposes. I think of it like this. It's a sword where the GP crafts a message and tells a story and lifts up that sword and runs into battle and the LPs follow. And then the other side is it's a shield. That's the legal parts that the lawyer prepares to protect you from claims down the road that you didn't disclose, this can go wrong, and this is how it's taxed and all of that. Not legally required. Why is it not legally required? We want you to have all the shield parts of the PPM. But we can do that in a number of ways. We can have disclosure in any format. But what a PPM does is it marries that disclosure, that protected disclosure, that shield, with the sword, if you follow my analogy, with the story of why invest in this fund. And that's why I say it's not needed, it's not necessary. If you can raise a fund without spending the time and money, crafting your story in a beautiful, color, graphs and charts and data. If you can sell this fund without that, you don't need that. We're still going to make sure you have the protective parts, but they may be in another document. Does that make sense?
It does, and we definitely, chose to go with one, and our LPs ask for it, and know to ask for it, and if you're a newer LP, definitely ask if they have a PPM, obviously, and so on that as well, on the terms and structure, for me. It was very important for me that as we raised the fund, the terms that we offered, the fee structure was market, right? You want sophisticated investors who invest in multiple funds. You just do. If you can at all raise money, you want it to be smarter money. And those folks know what is market. If you're charging a 50% promote, which there are people out there that charge that, you will be a laughing stock within the community of folks that are sophisticated and invest in funds. Like, yeah, you can get people to, I guess, give you, half the profit. Not folks that do this a lot, and that certainly, it is not market. So for me, I didn't want anyone saying, Don, I love your story. This is great, but your fees are too damn high, right? Or they're not market. So I spent a lot of time, not just with Yoni, calling other GPs in the industry, and and I realized a lot of things are not apples and apples. If you're a $75 billion fund, the management fee is going to be very different than, our fund was 50 million. Our next fund is going to be 75, which we are launching soon. And so the fee structure is a really big deal. Is it going to be 1%, acquisitions fee, dispo fee, etc. It's got to be market. The other important thing is the GP commitment, right? And that's how much money I'm putting into my own fund. And I think that there's a misconception out there. I don't think that it should be a percentage of the fund. I think it should be enough money where if that GP loses that money, it's a big deal for them personally, right? So if you have $100 million fund, but you have $1 billion net worth, and you're putting in $2 million and you lose it, it might not be the end of the world for you. But if you're someone where 500 grand is a lot of money for you, that says a lot. So I think that has to be, market, but there's a story beyond just, what percentage, right? Beyond that, new things that I have to kind of, look into now or deal with, fund admin, right? That's what Agora does. It's it's a portal where your investors log in, sort of like a stock portal, and a picture like Schwab. You log in, you see the properties, how much you put in, what's come back, etc. There's things like quarterly financials now, right? We have, a third-party CPA firm that every quarter by a certain date, publishes your fund financials. We now have, an annual audit. That's extensive. It's expensive as well. It takes time. A lot of emails back and forth, evaluations, that stuff creates more overhead for you. And also the investor updates are a big deal. When I was doing deal by deal, right, I would update investors kind of, I guess depending on who it was. Sometimes they'd be people that I talked to weekly anyway, so we'd be having dinner every week, and I would just tell them what's going on anyway. So there really were not a lot of formal updates. With a fund, hell yeah, you are updating your investors. For me, it's quarterly. Some folks do monthly. Some folks do, twice a year. And for me, every time I send an update, I tell investors, okay, like our next update will be on this date. Those take a long time to write. Like, you'd be surprised. I mean, I write them, I make them really long. Some LPs are like, hey, that was too long. Some are, say, hey, why are there no photos? And they say, why did you add photos? And it's like everyone kind of wants different type of updates. So your overhead definitely the thing. I want to talk about, like, when I made the change, there were advantages beyond the fundraising part that I never could have dreamed of, and they've been unbelievable. The number one thing that's the most important thing in real estate to me is deal flow, finding that next deal. And having a fund has been a crazy, I guess, weapon, right? And so you're giving that seller or that listing agent surety of close, right? We had a deal. Everything flipped for me about 2 years ago. We were, I don't know, not even a year into the last fund, or maybe it was 2.5 years ago. There's a large institution who was selling a property that I really wanted to buy, and we were negotiating. And during that process, they wanted to verify that we were indeed a fund. So they asked for a call to, basically discuss my fund. And they obviously knew what it took to run a fund, etc. And on the call, they asked me questions about our subscription line, about our, committed capital, how much have you called, things that I never would have been able to answer if I was deal by deal, because that large company did not want to deal with a deal by deal person who would then go scrambling around looking to raise money. And, I realized at that point, I mean, so we were awarded that deal only because we were a fund, and that will end up being one of the best deals in our fund. And that was my kind of holy smokes moment, because having a fund, when you put that out there, especially in a strip mall world, sellers know that the chances of you closing are much higher than someone who's deal by deal. We also have that subline, right? We use Citizens Bank, which is crazy, right? And so it's basically, like, we get around 25% ish. of our committed capital, right, as far as a line of credit goes. So they do all their diligence up front. That money is guaranteed by our, investor agreements. That, basically, like, they know that we have these agreements where, these LPs have to pay. They research who the LPs are, but then, if you find an $8 million deal, you literally can get the $8 million in cash within like 48 hours. Just comes right into your account. They don't even ask you what property is for. They've done all that diligence in the front. You don't have that with deal by deal. And so, again, surety of close is just something that it's just huge. And Yoni, I mean, are folks that are deal by deal, do they have access to sublines at all, or or is it's impossible to do?
Those two rationales to behind the fund that you just articulated, Don, are, I think, that's what it is. Like, it's a certainty of closing. It's knowing that sellers have that comfort in you because you have the committed capital behind you, and you have easier debt instruments because banks and others will lend you on the strength of your committed capital. So now, the flip side, I think, probably worth mentioning is, look, there's a downside to a fund, right? What's the downside to a fund? Mathematically, if you were to do 10 deals as one-off syndications and then 10 deals in a fund, if one of those 10 deals goes sideways, you're going to come out better economically as a GP doing 10 one-off deals when each deal stands on its own and you're not netting wins against losses. In a fund, everything is netted in one way or another. There's different ways to net it. There's different distribution waterfalls within a fund, and we could talk about that too. But because in a syndicated model, if one deal goes bad, yeah, you've lost money on that deal. But the next deal is a home run. You're making your carry, your promote on that deal without having to give those profits to make up for losses in the earlier deal. So that's why some people just like syndicating, and they have their style, they have their apparatus, they have their investors, and it's kind of like rinse and repeat. But to take it to the next, I think, take it to the next level where you have the credit lines, you have that capital behind you, and you can go after deals with such more vigor. I think that outweighs, from everyone I speak with, not everyone, there are those who would just prefer to stick to their existing model, but that is the story here. That really is the magic sauce.
Yeah, for sure. And the one thing that really changed for me, which was, by far the biggest difference between deal by deal and fund, and changed my life when and I didn't realize this would be a thing, is that clock. The clock that starts when you have that first closing and your investors are paying you a management fee starting X date, right? When you're deal by deal and you don't have that, right? There'd be years where, let's say we do a couple of deals, everybody's fine. The investors are, they're doing their own thing. They're not worried about whether or not, you're going to do 5 more deals that year or not. And there were deals, times in my 30s where maybe, we'd have a huge year, and the following year, whatever, or 6 months, I would take it a little bit easier, still do deals. And obviously, but it wasn't, there wasn't this clock. And what that means is, right, and I think where a lot of fund managers get in trouble, right, is if you're expected to buy deals, people feel that pressure and they start talking themselves into deals that they maybe would not if they were doing a deal by deal. Okay. Now, there's no faster way in really hurting your career than buying a bunch of stupid deals that you really shouldn't buy. It does you no good to buy a mediocre deal, and then 5 years later, 3 years later, it's a loser, and you're hating life a little bit, and your investors are asking questions. They're mad. Good luck at raising fund 3 or 4, whatever it is. So for me, that clock ticking every day, it's hard to state how much pressure I feel and felt from that, but it's not pressure to just buy deals. It's pressure to buy deals that are good deals, right? And for me, that never existed was deal by deal, right? There was pressure because, you know, I work hard, I have a high bar for myself, but now you've got LPs that are every quarter waiting for that update. And it was very difficult in 2023. We grinded like crazy that year. We called brokers. We did, you know, I do the whole social media thing because of deal flow. You know, I do this gala, I do the StripMallGuy brand thing, and that's for deal flow, right? I think we did a couple of deals in 2023. It was stressful, right? But I was like, I'm not going to buy a marginal deal. It makes no sense. And did it feel great updating investors? Hey, it's been a quarter now. We didn't buy anything again. No, but the smart LPs are actually like that. They're like, you know what? 2023, Don didn't do any deals. He obviously could have. He's got the money. He's got that subline, right? And then luckily in 24, that hard work paid off, and we did, I think, 6 deals. It was just like an amazing year for us. Funds looking really good, knock on wood. But do not underestimate the pressure once you sign up, right? But for me, it also means it's going to make you step up your game in a way that you never knew that you could, right? Like you will figure out, how do I get in front of more brokers? How do I do leasing faster? It just made our processes way more efficient, and it just made us better. It just sharpened our skills. But it's just something where you really don't want to start a fund unless you're ready to deal with the pressure, right? Look, there's overhead, right? Fine. We spend, let's say, give or take, $1 million a year on our overhead, our employees, rent, whatever it is. So it's like, you are paying for that because you have a fund, which is great. Deal by deal, it's hard to, but that comes with, that tremendous pressure. I mean, is that something that you hear much about, Yoni, from folks that, I mean, I love it. It makes me, work harder. We're more productive. We're running on kind of, all cylinders. But what do you hear from folks that make that switch on that point?
You're highlighting this tension, right? This contradiction that every GP lives with. I'll say about is pressure good or is pressure bad? Okay, what's the answer? It depends. A good amount of pressure creates diamonds. The right amount of pressure creates value, like that. Like what you were explaining in your case. Too much pressure will crush something, will crack something. Okay, when you design the terms of your fund, I can't emphasize this enough. A tiny seed will grow into a mighty oak. That seed needs to be watered. That seed needs to have the good genetics in it, right? That seed is your design of your fund. When you're designing your fund, you're putting your summary of terms together for your fund. You haven't built anything. You haven't formed an entity, but you're putting on a piece of paper what the terms of your fund look like. You're going to think through what's the right calibrated pressure, right? What is the period of time within which you must deploy your capital? And you're going to write that in your documents. That needs to be not too much and not too little. It's got to be just right. Because too long, you don't get the benefit of the pressure sitting on your hands, right? You're a syndicator again. Too short a timeline to deploy that capital, then you'll crack. And then you're running to do deals that are suboptimal because you have a window that's closing. So I agree with you. You have to design it to maximize the pressure to the right amount.
Yeah, no, I agree. And, I mean, definitely there are folks out there who run funds, who a lot of times just they talk themselves into deals. I see it all the time because they've got pressure to, deploy because they know, if they don't put all that money out, they're not going to get it back next time. For not LP, they don't want to give back money because then it gets into fees. It gets murky, but you just cannot. I mean, like you're better off giving back the capital and saying, hey, I deployed half, I'm not seeing anything, than buying a marginal deal. And everyone has that gut when they're looking at a deal, right? Forget the spreadsheets and whatever it is. Like, in your heart how that deal feels. And if you're like going home like, oh man, that's a no, right? Like when you were deal by deal, you probably, every one of those was probably a no, where you're like, whatever, I'll get that next one, right? On a fund, you're like, do I, what if the cap rates compress? It's like it's these dangerous things. You folks try to increase annual rent instead of 4% by 4.5%. They look at the model. What if rates go down a quarter point? They start plugging these things in that you're gambling on macro things like rent growth and cap rate compression, where maybe when you're deal by deal and didn't have the overhead, that investor pressure, you wouldn't have. So I would say for me, the biggest difference, and it's been great for me, is careful what you sign up for, because once you have that first closing, it's now years of insane commitment. It's 24/7. Every day I go home, last year I think we closed 6 deals. 359 days a year where we didn't find a deal. I feel like a batter who struck out in baseball. I'm a little bit bummed every day we get home and there's no deal, right? Which is totally fine. I'm not like crazy bummed, but it's not. But deal by deal, you don't have that difference. So a soft saying, we're out of time here in a minute, but yeah, that difference, I would say, be mindful of that game clock when you're looking to make that switch.
We're almost at the end here, and there's so many questions that have been coming up from this conversation. What we're going to do is we're going to send the answers directly to your mailbox, depending on the timing and how much the time Yoni has and Don has to answer all of these questions. There are a bunch of really great questions in here. I think for me, it was a really meaningful conversation. Any last words to say, Don, Yoni?
Just thank everyone. I mean, who tuned in, we're, love openly sharing and being helpful, and hopefully folks who took their time middle of the day on a Wednesday got a lot out of this. And Yoni, I'm sure, feels the same way.
Thank you so much. This was fun. We should do 10 more. This is a blast.
I love it. So as Yoni said, we're going to have a bunch of more of these coming up. Really appreciate everybody participating. We are going to send a recording shortly after we end this webinar. So you'll be able to see it in loops backwards to really understand everything that you wanted to from the conversation. Thank you so much, everyone, for joining.
Thank you. Thank you to Agora.